My name is Ingmar Bergmann. I'm an interim Treasury finance executive for more than 30 years already. Worked with many national, international companies, worked on regional offices and headquarters. In my Treasury career, I was able to help setting up Treasury departments, improving departments, but also on corporate financing, loan agreements, insurance, etc. I've been asked to talk a bit about interest rates to hedge or not to hedge. A very interesting topic nowadays. Now the interest rate increased compared to 12 months ago. So I will first look into, let's say, what can we handle when the interest going up or down, and then what kind of financing do we need, and only then we start thinking about hedging, yes or no. And if we think about hedging, yes or no, what kind of hedging opportunities are there? And I will at the end just have a simple case to try to combine a bit theory with, well, less theory, bit more pragmatic approach. So as mentioned, worked for many companies in the last 30 years, including private equity firms, listed companies, family offices. Few things in my career that I'm very proud of. That is the Silver Hamilton Award for implementing a Treasury center in Europe. Nowadays, people would say, who cares? That's very simple. I'm talking about the year 1994, when internet was not there, and we still were using the, I think it's called the R3 ERP system. By saying this, I do feel a bit old, but okay. Also, something I'm very proud of is a US private placement I did together with a company called Eneco, Dutch utility company. We still have the largest non-US dollar private placement, 776 million euros we raised. Maturities 10 to 22 years. Just as a starter, a small overview of how I see Treasury based on my experience. Treasury often is seen as transactional, in the sense you open bank accounts, or you organize the checkbook, or you reconcile the bank statements in your accounting system. I think Treasury is much more than that. Cash management, working capital, debt management, risk management, insurance, and not to forget the bank relations. I will not go through all these kind of topics, but what I can emphasize is that with every part of these layers, Treasury has to work with the colleagues in different departments in the company. So it's not only with the finance department, it's also with the sales department, procurement, the business development, legal, especially now with the Know Your Customer phase we are now in nowadays. So it looks like Treasury is a kind of ivory tower. I just want to emphasize that Treasury should never be an ivory tower. It should be amongst all the other colleagues in a company. Just look a bit back, more than 24 years, I would say. I started in Jan 99. That's also the introduction of the euro in Europe, in several countries in Europe, up till, I think this is from last week or so. So first of all, it's very fluctuating, the short term and the long term. And I just put some situations on these plots, just to give you an idea how come there's a big sharp increase or a very large decrease. It's not the right place to go very much into detail of all these stuff. I think it's important to see that it's very difficult to predict the interest rate development. So every time you do financing and you ask yourself, do I need to hedge, yes or no? Of course, it's good to understand what is the current interest rate market, but it's less important to predict the future. I think there are not that many companies or investors who were there at the right moment. Well, you all, of course, all know about the Californian SVB bank. Just because the interest rate increased rapidly, their investment portfolio decreased rapidly, and in the end, they get bankrupt. To give you an idea of the sharp increase, I'm talking about the last 12 months, where the short-term interest rate is something like below 0, and here is above the 3.5. If you have a 100 million euro loan portfolio and you're paying floating interest rates, in 1 year time, you pay 3 million euro per year more interest rate. Just an idea how important it is to have an opinion, should we hedge or should we not hedge? But before we start with should we hedge or should we not hedge, we should know that hedging itself is a derivative of the company strategy or of the business case. You should not hedge by hedging itself. I mean, if you don't have a house of your own, then you don't need a house insurance. That's also with interest rate hedging. So before we come to a point where we are wondering if we want to hedge yes or no, and what kind of hedging we want to do, you first have to think, okay, what is our strategy? What is, let's say, the 5-year corporate strategy? And what is the impact on the cash flow forecast? Also, in the cash flow forecast, how much buffer do you have in case the reality will be different? How much margin do you have? We've seen in the Ukraine war situation, a lot of companies had difficulties to price the increased procurement to the customers. There were companies that could do it. That was great for them. But especially the companies that were not able to price the increases to their customers, they had a very negative impact on their cash flow. So that means that their buffer itself was rapidly melting. Another question one should wonder is how much funding is required on the 5 years business strategy. And if we know that number, how do we want to finance it? If we know how we want to finance it, if we want to borrow funds, and that can be different sources, of course, do we want to have a maturity of 5 years, 10 years, 2 years, 3 months, etc., etc.? And then, of course, also, do we want to have short-term rates, long-term rates, or a combination? And now we are very close to the question, should we hedge or not? But before we do that, there's another hurdle, and that is, do we have an interest hedging policy? Interest hedging policy, before I go there, this is an overview of types of financing. It's maybe not all the financing you can think of, but just if you have a business case to finance your 5-year corporate strategy, you could finance it by leasing, factoring, you could get loans, short-term, long-term loans, project financing, but of course also equity financing. And each of these type of financing have their own characteristics. And for example, if you do a bond, be sure that you have a rating. Here, maybe a bit small. The green part is the investment grade level for the different rated agency, and the red part is non-investment grade. This has a major impact on your pricing, of course. So there are different forms of short-term and long-term financing, and most of these financing are normally short-term interest rated. What does it mean? That if you do project financing and you borrow, let's say 20 years money, your interest rate is updated every month, every 3 months. It's not a 20-year maturity of your interest rate. So that's something that we have to be aware of. I was referring to the interest hedging policy. It's very important. I cannot emphasize it too often, that if you want to do hedging, you have to make sure that the whole board is all on board. Everybody should be aware, what does that mean, hedging? Because the specialists know, of course, what hedging is, but already, let's say 2 desks further in the same room, people do not know what it is. And then it's very difficult to do a hedge transaction, because then people who do not understand hedging itself and how the governance is are afraid that hedging is the same as gambling. And in the end, hedging is not gambling. It's just the same as like issuing a house insurance or a fire insurance. So what I always try to do is to have the audit committee of a company approve the hedging policy. And so the treasurer will make a policy, discuss that with the CFO, and in the end, the CFO offers it to the audit committee. There will be discussion, and then it will be formalized. This way, you are sure that in every layer in the company, people are aware that there is a hedging policy and what does that mean. To include in hedging policies, of course, there are many topics you can include, but high level, you should make a decision, how much do you want to hedge? What I often see is that companies hedge somewhere between 70 and 100%, but it really depends also on how much buffer do you have. If you have very limited buffer, then it could be advisable to hedge more, let's say 100%. If you have a lot of buffers, yeah, okay, then you could maybe go to 70%. Also, what kind of instruments are they allowed to use? I always say, especially if there was no hedging before in the company, just keep it simple. Don't immediately go to options and all kinds of strategies. Just do the plain vanilla hedging and make sure that everybody in the company is aware, not only how it works, but also how you have to account for it. And if you do a hedging proposal, also have it in your governance documented how that will go. So people will put in a hedging proposal, there will be a meeting about it, and then there will be a formal approval to hedge, to initiate the hedge. And of course, every quarter, at least every quarter, evaluate what is the impact of the hedge versus doing nothing. Especially that last part is very important. I worked for a listed real estate company, and if I just go back, so here somewhere in 2012, you see the increase in the short-term interest rate on the euro, and at that time, a lot of companies thought this is going south. So what did they do? If they didn't already have hedged, they hedged their interest portfolio. And also the company I work for hedged their interest portfolio. So instead of floating interest rate, they hedged it on fixing interest rates. Of course, but that's only hindsight. A few months later, the interest rate dropped, even before zero. At the time I came there, the hedge was already initiated, was already done. Every quarter we had questions from the board. How could we be so stupid to hedge exactly at that moment? I have to admit, if we knew it before, we shouldn't have done it. But that was at that moment best decision my predecessor could make, because he also analyzed how much margin do we have if we have to fix it on this level, what is the impact on the business, what is the impact on the cash flow, and what's the impact on our rating. But a lot of people only look to the outside and said, okay, if we didn't do anything, it was now close to zero, and now we pay something like 1.5%, 2%. So it's good to evaluate every quarter and also share that with the board so that everybody's aware this is the reason why we hedged. Unfortunately, or maybe luckily, this is the current situation, and that's it. Now we're coming to, let's say, hedging opportunities. So we know how much financing we're looking for. We know how we want to finance it. Maybe a part with equity, maybe a part with borrowing from institutional investors, from banks, from private placement companies, etc., etc. So if we want to hedge, there are several choices. So we can do nothing, and that means we are on a floating basis. So every morning we will see what we had to pay per end of yesterday. And that can be, as we saw in this 20-year, 24-year interest rate history, that can be sometimes great, but sometimes also very painful. We can do 3 months interest rate contracts. So let's say every first of new quarter, we go to the bank and say, okay, I want to have a 3 months contract that will mature at the end of this quarter. And therefore you fix, in fact, your interest rate for 3 months. But if you continue that and you start do it again at the first day of the next quarter, you again will get the, at that time, market rate. So in the end, you just will follow the floating interest rate, but then only at a slower pace. That means if the market is going up, you will slower follow the market. But if the market is going down, you will not get immediately the benefits. You first have to go through your 3 months contract. What often is used is the interest rate swap. And the interest rate swap is in fact a swap between the short-term interest rate you pay to your bank on your loan and the fixed interest you receive from a third party. That third party can also be your bank. Yeah? So with one department, you have the loan, and with another department of the bank, you do the interest rate swap. But let's assume it's a third party. So how does it work? You pay to your bank, let's say, the 3 months interest rate. Every quarter, you pay the 3 months interest rate. And as mentioned before, here in this one, in the second alternative opportunity, slowly you are following the market up and slowly you're following the market down. So what is the added value? Well, you pay that, but because you swap floating to fixed, you will receive from your third party, your counterpart, you will receive the 3 months interest rate. So if you pay 4% interest rate to your bank, you will receive from your counterpart 4%. So in the end, it doesn't matter if it rises or going down, because it's a zero sum. In the end, you pay 4, you get 4. You pay 10, you get 10. You pay 1, you get 1. So it's zero. But in return of getting the 3 months interest rate paid by your third party, you have to pay in something, and that's the fixed rate. So if you have a loan, let's say for 5 years, what you can do is do an interest rate swap, and you swap the short-term interest rate with a third party. In the end, it doesn't cost you anything, but you have to pay the 5 years interest rate to your third party. And because you agree now what the 5 years interest rate is, it will be the same rate the next month, and after 2 years, after 4 years, up till 5 years. So you really fixed your interest rate for 5 years. That looks great if you want to hedge your total portfolio that way, but be aware of margining. Margining is in fact the difference between the market rate and the agreement you have with your counterpart. And margining is required in the situations that your counterpart thinks that you are not liable enough to step out the transaction and be able to pay the difference between the market rate and the contractual rate. For example, in future energy contracts, that is on a daily base margining because the fluctuations are that big. It can be very annoying. It can be very painful. So margining is one that can have a liquidity impact. If you do interest rate swap with a third party, be sure that that company is good for the money. So make sure there's a credit check. Do they have a credit rating? Is there a Dun & Bradstreet report, etc. Also, if you do interest rate swap, make sure that your colleagues on the finance department know how to account for. Because as mentioned earlier, interest rate hedging is often a very strange animal in the company. So there are different ways to account for the hedge accounting, not the hedge accounting, etc. Make sure that your colleagues do understand that. Another alternative, of course, the fixed loan with fixed interest. So I want a 5-year loan. The bank offers me a 5-year loan with a 3 months interest rate contract. And I say from the start to the bank, no, I just want to pay now the 5 years rate. So I get my 100% loan and I pay you the fixed loan for the next coming 5 years. Well, that's simple, because then you don't have to do all these kind of stuff you have to do with the interest rate swap for the 5 years. But the interest rate is fixed for the lifetime of the facility. So maybe you have other ideas about your hedging because of cash flows in 3 years' time. You are fixed to a contract for 5 years. Be aware of that. Also, if you want to refinance or, let's say, repay the loan before maturity, the interest, the bank always calculates a kind of penalty. And a penalty is, in fact, the interest that the bank could get minus the interest you're paying now to them. So on the floating 3 months, it's let's say, only the 3 months interest period. So if you cancel your facility at the end of your 3 months interest period, there is no difference in what they could get or what you pay, because you did cancel it just before you started a renewal of the interest rate. But if you have a fixed loan with fixed interest for 5 years and you cancel it after 2.5 years, the bank will say, okay, the market interest rate is X, you pay W. So for the next 2.5 years, I'm missing the delta between the two, and you pay the penalty for that. So that is what you have to be aware if you fix your interest rate for the lifetime of the fixed loan. Just coming back to bring it more in reality. So suppose we're acquiring a real estate for 200 million, and we think we need 150 million funding, and we think that around 90 million funding is required. So we issue equity, we will some long-term financing, private placement. Often they give loans for 10 to 20 years. And we also want to have some flexibility, and we do some bank loans up to 5 years. So before we say this is what we're going to do on the hedging, we first have to see what is the impact of interest on cash flow. So what is the impact if you have, let's say, you acquire a real estate where all your tenants have a 10-year contract. In that case, the risk on cash flow is limited. Of course, you have your credit counterparty risk. If your tenant is in default, they cannot rent anymore. But for the rest, from a business case point of view, if we just put the counterpart risk aside, you have a very solid base. So your cash flow is more or less guaranteed for the next coming 5 to 10 years. So that gives a different decision how you want to hedge in case you buy a real estate office without any tenants and you still have to find tenants, because then your cash flow is very limited. So increases in interest rate are difficult to absorb. If you make such kind of evaluation, also do the black swan. And my experience is, if you think the black swan is, let's say the base case is this, and the worst case is minus 10%, just make it minus 15% or minus 20%. That are real black swans. Then on the hedging instrument itself, they are based on daily rates, or do you want to have 3 months fixing? So all these kind of alternatives for hedging is in fact based on the business case. How stable is your cash flow? Is your cash flow very stable? Then you could think to minimize your hedge or even not hedge. But if your cash flow is very unstable, then you have limited room to maneuver and limited room to pick up the higher interest rate, and then you should hedge more. Just one part, even if you do nothing, is a hedge. So don't think that, okay, I don't want to hedge, I do nothing. Even that is a hedge, because a hedge is a direction of your risk, and doing nothing is also a direction of risk. This was my presentation. Any questions?
Ingmar, when hedging, is there some sort of formula you would use? You know, how much do you hedge over 3 months, 6 months, and 12 months?
Sorry, can you repeat that?
Sorry, can you hear me okay?
Yeah, I can hear you again. Yeah.
Okay. When doing hedging, should one look at, you know, how much you should hedge for 3 months, for 6 months, 12 months? Is there a formula you would recommend?
Nah, I mean, what I normally do is the hedge is for the maturity of the underlying loan, and the brackets are most of the time, it depends a bit on the currency, but most of the time 3 months. So on the euro and US dollar, it's often 3 months. So it's a 3 months swap. You also can do 6 months, of course, in 9 months, but more popular are the 3 months. And the more popular the term is, the more transparent the pricing is.
Has anyone else got any questions? Andy?
There was a recent change in the accounting pronouncements here in the United States, which basically allows you to institute multiple hedges of various lengths and starting periods on like a fixed rate loan portfolio. And I was wondering if you could address how that would affect your strategy.
Well, I'm not that much in accounting, so I was also not aware that there was a change. But I do agree that no, coming back, I'm not that much in accounting. What I would like to emphasize is that, like, hedging is a derivative of the business strategy, accounting is a derivative of the hedging strategy. So again, I don't know what the impact is for the accounting, but you should try avoid that your hedging strategy is based on the accounting.
Well, let me give you an example here. I typically have hedged loan portfolios, and they prepay, and so the hedging ratio will change over time. And so under this new accounting pronouncement, I mean, let's say you have a 30-year loan portfolio. For the first 10 years, you could have one hedge in place. And then for the years 10 through 20, you have another hedge in place. They're usually swaps. And then for the last 10 years, you'd have a third hedge in place. And the reason you do that is so that the hedging ratio can remain fairly stable over time.
Yeah.
And so, but it's a new concept. It came about as a result of a change in the accounting pronouncement here in the United States. That's what I'm trying to get at.
Yeah. Okay. Well, sorry, I'm not aware of that part on the accounting impact. But do you also have an idea if by having this included in your accounting that the numbers above or below the line are improving?
Well, it doesn't really have a lot to do with the accounting. It has a lot to do with the hedge ratio itself. So it looks like you've hedged like 90% of the principal on this loan pool. And so as this prepays, if you have multiple hedges, your hedge will, that 90% hedging ratio will maintain over time, usually close. It won't be exact. So that's what I'm getting at. I mean, the accounting, you run the accounting thing here to see what impact this will have on your margin and your cash flow. And so you just run a simulation like that. It's not dictated by the accounting, but before you could not do that.
Okay. Sorry, I cannot answer that question, Andy.